When you invest in real estate, there's not just one way of going about it. And novice real estate investors, they go out there and I'm just going to borrow a mortgage and buy a property and blah, blah, blah. There are dozens of different ways of structuring real estate deals, some of which don't require that much money from you coming out of pocket. So we wanted to speak with someone who has done a lot of creative deal structuring for real estate investors and in real estate deals. Bishoy Habib is a real estate and business attorney, over a dozen years experience representing real estate developers, investors, financial institutions in over 1,000 complex transactions totaling $12 billion. Bishoy, walk us through just the basics of some of the ways that you see real estate investors structuring deals creatively and how those creative approaches help those investors.
Yeah, thanks for having me on the show first and foremost. As a deal making attorney, this is really what I love the most is figuring out how to make two parties who want a deal to get closed close that transaction. And there's always going to be obstacles, and the better the deal, I like to think that typically there's more obstacles because there's less competition, which makes less competition, which means there's more upside in it usually. As we all know, interest rates were at record lows a few years ago. And so really nobody was thinking about creative financing because why would you care, or creative deal structure? Because why would you need that when I could go get money for free at 2.5 or 3%? But what happened was when the Feds raised the rates and the mortgage rates increased and the cost of borrowing doubled and even tripled depending on what your rates were, all of a sudden that froze the markets, right? And so you just everything the deal had to make a lot of sense for you to take 7 or 8% loan for it. What we started seeing in that time frame was a lot of creative deals. And creative deals are not new, creative deal structures are not new, but when they come out the most is when times are tough and when rates are high. And that's what we've seen over the last, let's say, 2 years or so. The number one There's two main ones that I've been seeing a lot of. Okay. One is pretty straightforward. It's the seller financing. We all know about seller financing. I want to buy Brian's property and I don't necessarily have all the money, but I'll work something out with Brian where I say, listen, I'll give you 5% on your money and I'll borrow $200,000 from you. So I buy the property for 400, I give him 200 at closing, and then I pay him back that 200 plus the 5% that we agree on every month. It's pretty straightforward. Brian acts as the bank in that point. He does have some risk if he has to foreclose, and every state has different laws on that. So there is some risk, and so he should be rewarded for that risk because if he has to take the property back, that's going to be a difficult situation. That's pretty straightforward. There's not too much to that. What I'm seeing a lot of that there is more complications with is subject to transactions. And a subject to transaction, that's what we've seen a ton of since the interest rate spiked. And subject to means I'm buying Brian's property, but instead of it being free and clear with his mortgage, I'm just taking the property subject to, right? Or in other words, leaving in place the mortgage that he had originally taken out. We see this with a lot of 2019, 2020 loans, 2021 loans. Those are the big 2 years. And even a couple of years before that, rates were still lower than they are now. But if you got a 2020 or 2021 mortgage and you're at 3%, that's very appealing. And what that means is I would be willing to pay Brian more for his property if I could get that 3 or 3.5% rate than I would pay if I was getting a 6% rate because my payments will still be less every month. And so I put more money in his pocket at the end of the day, and it's less money out of my pocket at the end of the day, right? And I don't have to get approved by a bank. I don't have to go through the underwriting process. I don't have to give all my financials. I don't have to wait for the bank to approve it, get an appraisal. All of that, all the fees on the front end, all of that is completely negated. And so I just work something out. I buy the property, we leave the loan in place, and then I start making the payments to Brian. Is this technically allowed by the terms of the loan documents? The answer is not really. Is this illegal? The answer is no, it's not illegal. You will not go to jail. There's nothing criminal about this. You're just technically, the loan could be called due. But if you have a smart attorney who knows how to structure it properly, you can very much minimize and mitigate that risk to a very small level. And that's what I do. I help clients structure the subject to transactions in a way that there's always going to be risk, but we mitigate that risk. And like I tell all my clients, risk is part of the game. If you want an attorney who negates all your risk, it's not possible because you can't make money without taking risk. They go hand in hand. It's just a matter of, do you understand the risk that you're taking and are you okay with it? Risk adjusted return is the term that I always like to use. So, with the subject to transactions, there's a ton of potential upside for the buyer, and you can make more money as the seller. It does come with inherent risks. The first risk that I just mentioned is the loan being called due. I won't dive into it on this podcast here, but there are ways that we can mitigate that risk. Other risks are what happens. Each party's kind of married to each other, right? Because I'm assuming that the buyer's going to pay. And as the buyer, I'm assuming that the seller's not going to do anything screwy with the loan to get it called. And so there's risks. What if the buyer doesn't pay the taxes? Then it shows up as a foreclosure on the seller's credit, right? And so we really have to hone in on the documents internally, the subject to documents that we have in between the buyer and the seller of the property. And that's why those become extremely crucial in a subject to transaction. So I'm seeing a ton of those. People are finding deals. And so the subject to and the seller financing for me are the two biggest things I've been seeing, two of the biggest trends in investment real estate over the past 2 years that I've been seeing.
Yeah. So, yeah, subject to deals they're great for the buyer, like you said, they're great for the seller as long as the buyer actually pays, right? Because the seller is still liable for that old mortgage. And of course, there's the due on sale clause. So the lender could call the loan if they discover that the property was sold. So how do you go about protecting against it? Do you like a wraparound mortgage, or how do you protect, high level overview, how do you protect against the lender discovering that the property was transferred? And how do you protect the seller from buyer default and ruining their credit and having foreclosure appear on their credit?
So, in terms of the due on sale clause, the Garn St. Germain Act of 1980 specifically stipulates that lenders cannot call a loan due if the owner of the property transfers it into a revocable trust for estate planning purposes. And so we utilize, and best practices for subject to transactions is to utilize trusts to facilitate the transaction. Again, I won't bore you with the details, but that's one of the things we hang our hats on.
Very clever. I like it.
And so even if the lender did find out, and they still could find out as public record that the property technically transferred, we have kind of ways to respond to that, right? So we
Yeah,
have a
you have a
defense.
defensible position.
Exactly.
Yeah.
Exactly. That's number one. You asked, how do we handle it if one of the parties defaults? The buyer is more likely the one that we're worried about defaulting. You can't force the buyer to pay if he doesn't want to pay. But I'll tell you this, I represent either side, right? I could represent the seller. I've done that. I could represent the buyer. I've done that. Depending on who I'm representing, I'm drafting the documents completely differently, right? I'm just telling you that straight up. If I'm
Right.
representing the seller, I'm going to make it very easy for them to snatch that property back without going through the rigmarole of the foreclosure process,
Foreclosure.
because nobody's going to win in that case. If I'm representing the buyer, I'm flipping the script and it's going to be incredibly difficult for the seller to take back the property. So I have a ton of time to figure out, if something goes wrong, how do I resolve this issue? You can't force the buyer to pay, right? You can't force the buyer to get insurance. You can't force the buyer to pay tax. You can't force the buyer to do anything. So there's inherently a risk. One of the downsides, the parties are still married at the end of the subject to transaction, even though they don't want to be usually. When things are good, they're great. It's like a toxic relationship. When things are good, they're great. And then when they're not good, I've been involved in that too. And they get ugly. They get ugly because everybody's depending on the other person in good faith. And so we prepare internally, depending on which party I represent, we prepare indemnifications and hold harmlesses and guarantees and all kinds of internal documents that theoretically my client could take the other client to the cleaners if they don't perform. Does it ever get to that point? It could. I haven't actually had to go that far because just having those documents in place a lot of times prevent the nuclear option where one party just says screw it and does whatever they want. But it doesn't mean it's always smooth. But having those documents in place are preventative measures to say, I have leverage here. If you don't do XYZ like you said you were, then I will do XYZ. This agreement says I can.
Right. The
And that's kind
deterrent
of the point of
factor.
what I do.
Yeah.
Yes, turn. It's all about life is about leverage. That's one of my favorite things to say. And I just every day it is more and more true.
Yeah, and one thing that you didn't say this directly, but it's worth highlighting here is this is why it's so important to hire your own attorney to protect your interests. You talked about how you structure this deal very differently depending on which side is your client. You're trying to protect your client as best as possible. A lot of times people will say, "Oh, there's a lawyer involved. They'll straighten out the legal stuff." Like this is why it helps to have a lawyer who's protecting you personally and looking out for your best interests, even if there is another lawyer involved in the deal, structuring it from a legal standpoint. So that's an important thing to remember in all kind of legal transactions, but real estate in particular, where you're dealing with assets that are worth hundreds of thousands of dollars, millions of dollars. Troy, in 30 seconds or less, how do you help people and how can people connect with you if they want to take you up on that help?
Absolutely. I'm a deal-friendly real estate attorney. I'm based here in Tampa, Florida. I work all over the state. And I love working with investors. I love working with lenders. I love working with developers and builders and brokers on their real estate transactions. So, easiest way to reach me if you're on social media is my handle is at attorney Bishoy, Bishoy. That's Instagram, TikTok, YouTube. You could find me on LinkedIn under my name. And if you're not on social media, that's okay too. My law firm's name is Levacy Legal. That's Lev like Victor, ACY legal. And the website's levacylegal.com. And my email is bishoy at levacylegal.com.
Bishoy, thank you so much for joining us today. And guys, if you enjoy these quick, focused conversations that we have with outside experts, please rate and review the show. It makes a world of difference to us. And on that note, we will catch you on the flip side. Want the cash flow, appreciation, and tax benefits of real estate without becoming a landlord? You've heard of REITs and real estate crowdfunding, but you probably don't know much about 5 other ways to invest passively in real estate. So we put together a free video course for you to show you how to consistently earn 15% plus returns from 5 lesser known hands-off ways to invest in real estate. And even more importantly, we'll keep risk front and center in that whole discussion. Because really, what's the point of investing for high returns if you also take on high risk, right? So visit sparkrental.com/free to take our free course. Each video is snackable at 10 to 15 minutes long, and the entire course takes less time than watching a movie. Looking forward to chatting with you from within the course.